Christian Family Radio. We're Derek and Bridget. Wednesdays on the show, we love to help you to see money as a tool, not just as a goal. It's the thing we call money mindsets with our friends at Lock Shield Partners.
Always thankful to have Clark Hayden along with us. And we're talking about the Federal Reserve. We call it the Fed most of the time. It has a role in the interest rates, Clark, but not maybe as much as everybody thinks. And if you can give us some clarity in that, I think it might clean up the water cooler talk that's going around everywhere.
Sure.
The accusations may come down.
Let's dive into that, Bridget. So you're exactly right. The Federal Reserve implements what is called monetary policy. Really, all that means is they set what is called the federal funds rate. So the federal funds rate is what banks use if they lend each other money overnight. That's what the federal funds rate is. And there are lots of different reasons why banks may lend each other money, and we don't have to get into all those right now, but that's what the federal funds rate is for. So you may hear the terms sometimes tight monetary policy or loose monetary policy, or you might hear that the Federal Reserve is hawkish or dovish. These are all the different terms that you've probably heard on TV before. So what does it mean? So in essence, the Federal Reserve raises interest rates when inflation is high. The reason that they do that, that would be tight monetary policy or hawkish monetary policy, is because they are trying to limit the amount of spending that takes place in the U.S. economy. When consumer spending comes down, demand falls and prices come down, or prices cool. So that's exactly what we're living in right now. In a time of economic stress, the Federal Reserve would lower interest rates because they are trying to encourage the U.S. public go out and apply for mortgages or car loans or spend your money on whatever to let's ramp this thing back up again.
And so that's why during the pandemic years, we saw interest rates of like 3% and maybe even lower on some mortgages.
That's exactly right, Derek. And it goes much further than just the rate that you pay on your mortgage. The interest rate of the federal funds rate has a very profound impact on the jobs market also. If interest rates get really, really high and people are spending less money, what eventually happens to companies? They make less money, which means that there's less money to pay employees, which means people get let go.
Oh, yeah.
A big cycle.
It is a big cycle. Very interesting. Very interesting. If you want to find out more about what we've been talking about today, please head on over to ChristianFamilyRadio.com, or you can also check out LockShieldPartners.com.